Welcome to Business Innovators Radio, featuring industry influencers and trendsetters sharing proven strategies to help you build a better life right now.
Hello and welcome to the Business Innovators Radio Podcast. I'm your host, Rick Brown. Joining us today is longtime Sacramento real estate finance leader, Sara Jung. Sara's real estate finance experience includes underwriting, negotiating, loan structuring and packaging, including new construction, renovation programs, specialty loan programs, and multi-unit financing. Leveraging her sales experience and using a set of systems and processes that she developed, Sara built a highly successful mortgage business that won multiple awards over several years for sales production and service levels. And in fact, in 2018, was named in the top 1% of mortgage originators in the country. Today, Sara owns and manages Legacy Equities LLC in Sacramento, California, where she focuses much of her energy as the company's acquisitions manager for property investment, helping her clients take part in ownership of multi-unit commercial properties as limited investors. And she joins us today to help us make some sense of the commercial property investment space. Sara, welcome to the show.
Thank you, Rick.
Full disclosure, I will let folks know that you and I have sort of known each other for about the last 3 or 4 years. In fact, you helped my wife and I with our mortgage when we moved to the Sacramento area a few years ago. But flash forward here to just a couple of months ago, and I get an email from you announcing that you're leaving the mortgage industry to focus on real estate and specifically multi-unit commercial property. So first of all, congratulations on all your success in both the mortgage industry and with your new venture. But why the switch?
Yeah, so Rick, thank you for that really wonderful introduction. So the switch has been, I've been in mortgage and real estate financing for the last 17 years. And, over the years, what I've noticed was a lot of my clients that I've been working with, the majority of them really don't have what they would really need to either retire or have a savings or build up equity or build up funds for a rainy day. And so, one of the things that evolved over the years was just my concern and passion just for the clients that I've been working with in finding ways for them to actually build wealth and build equity through real estate. And so what evolved over the last couple of years was my husband and I invest in our own real estate and we invest out of state. And so we were understanding and reaping those benefits. But what it actually evolved was, how do I scale into more units? And so instead of just investing into a single family property, how can I scale that into a 2-unit property? So we ended up going into multi-units. But one of the passions that I had was, how can I help people figure out ways to invest passively and get residual income from real estate? I understand there's a lot of ways to get residual income, but definitely real estate is a physical asset that you can invest in and actually get cash flow from tenants, and it helps pay for itself. And so kind of through that process, I got more interested in the multi-unit space and decided to go full-time into that.
And as we get into this, I want to make sure that we all have a common understanding of a couple of the terms that we've thrown out here already. Help us to clearly define what you mean by a multi-unit commercial property.
So multi-unit and commercial is anything that's over 5 units. So typically in residential lending, 1 to 4 units is the standard size of that you can get for agency financing with Fannie and Freddie for conventional financing. So anything above that is going to be considered multi-unit commercial. And that can go all the way up to from 5 up to 300, 400, 500 units. But the average unit size that we see is anywhere from probably like 100 to 200 units.
And you're typically talking about apartment buildings, yes?
These are apartment buildings where residents are renting. And sometimes they have amenities like pools and gyms and playgrounds, and some of them don't have any amenities at all. They could be a 50-unit apartment building.
Okay, I have a lot of questions about this, but first let me ask you what your ideal client looks like in regards to multi-unit investing.
Yeah, so the ideal client is really somebody who has experience investing, whether they are investing into stocks or real estate, and they are really looking for a way to get better returns on what they have. So maybe they're in the stock market and maybe they feel a little nervous about the volatility of the stock market and they want to diversify into something else and possibly into real estate where maybe, it could be a little bit more stable. It could be somebody that has a 401k or an IRA and maybe that's not performing to their satisfaction and they're looking for ways to improve the performance of those funds. So preferably somebody that has funds either in brokerage, 401k, IRAs, and they're just not happy with the returns that they're getting, or they're nervous about the future and they want to diversify and kind of not have all their eggs in one basket per se.
And so aside from the fact that this is kind of the niche that you're in, why apartment buildings? I mean, what makes this type of real estate a good investment? Yeah, so one of the things that I really like about apartment buildings is the ability to scale. So first of all, it's a physical building that you're investing in. You can see, touch, feel it. It's not something speculative like the stock market. It's something that we can actually help control how the income is performing as far as how much we're charging in rent. We can control what the condition of the property is, whether we need to upgrade or renovate it, or if there's maintenance that needs to be done. So we as investors can help control that asset in terms of how it performs. With multi-units, the really great thing is that you're scaling not just with one unit, one tenant, you're scaling with maybe 50 tenants or 100 tenants or 500 tenants. And you're really taking advantage of the economies of scale because if you have a vacancy, you have your tenant leave a single family home, you're stuck. You're stuck with that mortgage payment. And then you got to scurry around and find somebody else to fill that spot. And then in the meantime, you're paying the mortgage. And maybe you have some capital expenses that came up, like you have to replace the roof or you have to fix unexpected things and you only have one tenant to pay for it. Well, with multifamily, you can exponentially take care of that where you have maybe 50 or 100 tenants paying and helping pay those expenses for one roof, for kind of condensing and sharing the cost of the expenses overall. So it is, in terms of what I would describe as far as risk, it is a safer place to be than a single family or even maybe one or two unit, because again, you can distribute the risk across multiple tenant income streams. Yeah, that makes perfect sense. But when you're talking about having to do this type of maintenance and repairs to a larger multi-unit building, doesn't that get a lot more expensive?
Well, it is more expensive because again, you're managing 100 units and you're managing 100 tenants. But the nice thing about the multi-unit is that it's all under one roof. So you have one management company. So instead of paying 3 or 4 or 5 different management companies, you're paying one management company at a reduced management fee. So there is a reduction in cost from a management fee standpoint because it is all under one umbrella. The other thing is we have to think about too is that again, we're getting income from multiple tenants across the board. So from a cost standpoint, it is expensive, yes, but when we do the analysis and we look at what our returns are on that, it's a lot more efficient when we have multiple doors versus just one door.
Is it more difficult to finance a multi-unit building as opposed to a single-family home?
You know what? It's actually easier to finance a multi-unit commercial building because lenders, when you get a residential mortgage loan, they're looking at you as the character of you, your credit, your income, do you pay your bills on time? They're looking at all that stuff. When you get a commercial loan for a multi-unit apartment building, they're looking not at you per se, they're looking at the income that's coming in. They're looking at the business plan of that asset. So they're looking at the net operating income. They're looking at all these other facets of the property versus your personal credit. So it's very different. And actually, I've talked to a number of lenders because I'm in the field. It's actually easier to get a loan to finance a multi-unit building versus a residential.
Interesting. I mentioned earlier too, a limited investor, that you work with folks to get them in as a limited investor. I'd like to get some common understanding of that term as well. What does that mean to you, a limited investor?
Yeah, so limited investor, so what that means is that, so we set up what we call a syndication. And so when a syndication is basically, it's a legal process for us to pool investors' money together to purchase and acquire a piece of real estate. There's 2 investors involved. There's the general partnership, and then there's a limited investor, or what we call LP. The limited investor is the passive investor. So they're the person that's going to invest a dollar amount into the deal, and they will basically sit back, let all of the general partners do all of the work, and they collect a paycheck. So they will collect the paycheck. They get a portion of the cash flow that comes in from the rental income, and they will get the benefit of those distributions along with the benefit of sharing the profits of the sale of the property in 5 years.
What kind of investment are we talking about here as a minimum?
Minimum investment, it really depends on the deal, but generally speaking, it can range anywhere from $50,000 to $100,000 is the average minimum investment. And again, that just depends on the deal.
Is there any merit to having a multi-unit building and it being harder to keep occupied? I know you talked about, you have multiple tenants as opposed to one in a single family home, but are there issues that people need to understand about trying to keep tenants in there?
So one of the important things that we do up front is we do a very thorough underwriting analysis based on occupancy rates for that building. And so we never assume that the building's going to be fully occupied. We always assume that the building could have a high vacancy rate. We always assume a standard of 90% vacancy. That's actually what most lenders will use. And we have to be able to build in and be really conservative with, if we lose X amount of tenants and our vacancy is at 85%, how's that going to affect our cash flow? And so the other very important part of this is the asset management piece. In terms of managing, it's one thing to find and close on the deal, but it's another thing to actually manage it so that it performs based on the business plan that we plan for it. So we have to do a lot of due diligence in terms of managing the property manager, making sure that the tenants are happy, and that we have a property manager in place that is accommodating to the tenants' needs and watching the expenses. And so if that part is not being managed, then it can quickly deteriorate and we can start losing tenants and those vacancy rates can start to increase. And so we want to just be very mindful of that. And that's another very important aspect when dealing in this kind of real estate space.
So I feel like I'm jumping around a lot here in this process. I wonder if you could just give us a really simple kind of from start to finish, how this process looks when you get together with a group of investors to make this happen. So
the basic process is very similar as if you were to just go out and buy a piece of property yourself. So if you're going to buy, look for a home, you're going to go out, buy a piece of residential property or whatever you might be, whether it's a second home, primary investment, we go out and we look for the property. So first of all, you have to identify the property. You have to also identify what market you're going to be in. And so we look in markets in the southeastern part of the U.S., so between Texas to Florida.
Is there a reason for that?
Yes. There's actually a few reasons, but one of them, just the biggest one, is that the West Coast has just become too expensive for it to really make sense to get the returns that we're looking for. And also just the migration to the Southeast has been booming in the last few years, and that's where a lot of the companies are moving to. So we're seeing a lot of population growth in those areas.
Okay.
So once we've identified the property, we've identified the market that we want to be in, we have vetted out the location of it, we underwrite it, we analyze the cash flows, we analyze what kind of returns that we can get for our investors, we look and see what kind of capital expenditures might need to be able to go into it. We make an offer, assuming that offer has been accepted. We work with the seller on getting our inspections done, doing the appraisal, getting the financing in place. And once all of that is completed, we also go back to the investors and we present an investor package and we review the deal with the investors and ask them if they would like to invest. At that point, once all of the capital is raised, we close escrow. So just like on a normal escrow transaction, we close escrow. The property gets turned over to us as the general partners, and then we start management of the property. The standard hold period is 5 years. And at the end of the 5-year term or at the end of that hold period for that particular deal, then we sell the property and we split out the profits with the investors.
And you and Legacy Equities manage this from kind of soup to nuts?
Yes. So it's really important to understand. So this is not a one-person show. This is a huge team effort. So myself with my company and then also with a couple other partners, we actually all work together as a team to make sure that these succeed. So one of my partners is Vinny Chopra with Monil Investments. He's out of the Danville area, and he owns almost 4,000 units, and he's been doing syndications for, I believe, about 15 years, and he's done over 27 type of syndications. And so there's also a couple other partners that I work with in Texas, and they also are experienced investors, and they're much more connected to the broker world because somebody also needs to find the deals. Deals are very hard to come by the way, that actually makes sense. So collectively, we all work together to find, acquire, manage, and then sell the deal. And so all of that does come together. But yes, I do have a hand in everything from the beginning to the end with my team.
What do you suppose one of the biggest misconceptions might be about getting into this type of investment?
I'm finding that, people have misconceptions that real estate investing or commercial real estate investing is just for the big guys. It's for the corporations or institutional investors or, a lot of people never think that they could even participate in anything like that. And what I'm finding is through a lot of education, most people don't realize that they can participate in these kinds of transactions and they can reap the benefits, and really a lot of benefits from a tax standpoint. They can share in the depreciation, in the not only cash flow, but also the tax benefits in owning a piece of it. So it is kind of surprising, kind of as I've been talking to a lot of investors, that they just don't think that they're a candidate. And, once we start talking and I kind of, find out a little bit more about their story and what they're looking for, we find that actually there are a lot of opportunities for them to participate.
Is this something that you can use other funds for to invest in, like your 401k, for example?
Yeah, absolutely. And that's actually something that a lot of people don't realize is that people think that they have to have cash to be able to invest. And that's actually not the case. There are specific 401k funds and IRA funds that can be rolled over. And again, I'm not the expert in that. However, these are available to investors to use 401k funds and IRA funds to invest in the real estate and still benefit from the depreciation and everything else that comes along with it.
I'm interested. I mean, you're well-versed in this market. Where did this come from for you? How did you get into the mortgage industry and into real estate to begin with?
Well, that's a good question, Rick. So short answer is, I got into mortgage. You know what? I got into mortgage very early, back when rates were above 7%.
Wow.
So I've been doing this for a long time and been through a couple cycles. And, I've always just had a great passion for financing, and I love real estate. I met my husband, we actually met at the same company. He's been in real estate for almost 20 years. And so it was just something that just came naturally to me. I actually started in sales, in technical sales. And somebody said, hey, you'd be really great in mortgage because I was actually explaining something through a sales presentation. So I got into the mortgage business, and actually somebody mentored me in the mortgage business. And I quickly became very successful in that, in the purchase market, not in necessarily the refinance. And in the real estate side, I just find that over the years, just real estate provides so many benefits to so many people. And I talk to so many people that have not quite jumped in yet. And I just wish that they would have jumped in earlier. And, even for myself, I wish that I would have jumped in this 10 years ago. And I could kick myself sometimes when there was deals that I didn't participate in, or there's something that I could have done. And, there was a saying that I heard, and I forgot who it was from, but they said, you don't wait to buy real estate. You buy real estate and then you wait. And that really resonated with me because there's been so many situations over the years where, like, even through the crash, even through the real estate crash, we recovered from that too. So real estate is a long-term investment. You're not going to make millions overnight, but if you're willing to stay in it for the long run, I find that it really can help a lot of people. It can really help build wealth. And so the bigger picture for me is what I can do with wealth. It's not about, making money necessarily from the real estate, but really about, what I can do in the bigger picture for other people.
So if it's a long-term kind of a thing, you mentioned earlier that you scope these deals for a 5-year period. Is that enough time to realize a return on your investment, or are we talking multiple sets of 5-year deals?
Yeah, so in the multi-unit commercial apartment space, 5 years is the standard hold time in the industry. Now, there are other situations where, depending on the type of deal it is, let's say, for example, if the property was distressed, it needs rehabilitation, or maybe needs some renovation work, maybe a 5-year period would not make sense. Maybe more of a 6 to 8 year period would make more sense. So 5 years is kind of out the door, but it's not necessarily a fit for every single deal that we do.
And I can understand hesitation into getting into it. I mean, you mentioned a minimum of about $50,000 to $100,000. I mean, that's a lot of money for most people. I mean, there aren't any guarantees.
Right.
But how do you help people to kind of wrestle with that decision?
Yeah, so it is a lot of money. So there's a few things that if you're going to invest that are very important. One is, you have to look at who you're investing with. You want to make sure that you're working with an experienced investment team. Again, this is not a one-person type of show. This is something that is done with a team of people that bring all of their experiences together. You want to look at their history. You want to look at their track record. You want to look at their integrity. You don't want to put money where you cannot trust somebody. So you need to make sure that not only do you like that person, you trust that person, but you also need to trust that person in that deal. Now, I look at the whole picture. So I look at everybody that's involved in the deal. I look at the different general partners. I look at the sponsors. And I look to see how comfortable am I to put my money there. The other thing that I recommend that people consider is just the deal itself. I encourage everybody, anytime they invest in anything, to always get different opinions, run it across different people, and make sure they vet it out. But you have to look at, is the deal realistic in terms of giving you the returns that you're being told? What are the risks? You want to make sure that the deal is transparent so that you can see all of the good and bad parts of it, because every deal has pros and cons, and we just need to make sure that we mitigate those risks. And the other thing that I believe in too, just for me personally, is I've told all my investors, we have a good amount of funds that we can invest in ourselves, and we started, this is why we started buying property. But every deal that I do, I have committed to my investors, I will also be doing our own minimum contribution. And so not only as a general partner, but also as a limited partner. So I will be playing both roles, putting my personal money into it, as well as asking the investors to put their funds into it as well. So again, just, making sure that you're vetting out the investor that you're working with and making sure that they're being very transparent about themselves and about the deal that they're in.
Some good information right there. I appreciate you sharing that. Hey, before we let you go, can I switch gears on you a little bit here? Are you familiar with the Proust questionnaire?
No, not offhand.
Oh, well, Marcel Proust was a French writer back in the early 1900s who believed that in answering this list of 20 questions that he put together, that an individual reveals his or her true self. Pretty harmless questions. There's no right or wrong answers. They're just kind of fun. And I like to always kind of bring this around to the human side of things, right? We're all trying to work and build this business, but we're all also humans with vulnerabilities, et cetera. So I think this is a nice way to show that. So you game for that?
Absolutely.
All right. I'll only ask you a couple of them here.
Okay.
Let's start off with, what is your idea of perfect happiness?
Wow, Rick, you really challenged me. Perfect.
No right or wrong answers.
Okay. So first of all, it's a little conflicting because I'm thinking that there's nothing that's perfect. But if I were to, I guess, think about perfect happiness, it's really just about creating the life that you want. It's not about, in terms of money or wealth or the things that you have or any of that. It's about what really is important to you, like your friends or family. Having a roof over your head is very important. Having your needs met, all of the basics are important. But ultimately, creating a legacy, and one of the reasons I named the company Legacy Equities was because my husband and I, we wanted to leave a legacy for our family. When I pass, what are they going to remember me for? What I did, not what I had, but what I did in my life. And that to me is probably the most important.
Yeah, I love the word. I connect with the word legacy very much. And because when I was a younger guy, familiar with the word, but never really thought about its meaning, thought about what it means to me personally. And then I connected with somebody several years ago who kind of explained it to me, like, what is your legacy? And exactly what you're pointing out here. So I just think it's a really cool word and a cool thing to think about. So I love that answer. Excellent. What is your current state of mind?
So, my current state of mind is really just being positive, making sure that, I surround myself around positive people that have a similar state of mind, I think is really important. And just really not giving up on your dreams or what you want to accomplish. There's a lot of challenges and difficulties that come with anything really. And I think it's just, having the resilience and the tenacity to stick with things. And I really enjoy, being around people and talking to people that have been through things where they can share stories of their resiliency and things that they've been through, and being able to relate to them and share together. But I think that the positivity is such a big thing, and sharing the positivity with other people and having something that I can share not only personally, but also professionally.
Very nice. And by the way, these aren't my questions. These are Proust's questions, right? Well, I'll give you
questions.
I'll give you one of my questions. You'll see the difference here between Proust and myself. So here's my question. Who's your favorite superhero?
Oh gosh, that has to be Wonder Woman.
Perfect. What? Any reason why?
She's amazing. She's got superhuman powers that I wish I had.
Okay, that leads you apparently have seen my list of questions, because that's my next one. What talent would you most like to have?
Oh gosh, being able to fly.
Get that one a lot. So like fly, like you want wings, or you want a jetpack, or what?
Well, you know what? When I was a kid, I actually always dreamt that I could fly, and I would be, soaring and flying like a unicorn. So yeah, I would like wings, but thanks for asking.
Do you have a favorite author?
Yeah, actually. So right now I'm reading Tony Robbins' Money Master the Game. I'm about halfway through, and Tony Robbins is amazing. I've been a fan of his for a long time. And I mean, he is just an amazing person. I just recommend to anybody who hasn't read his books or listened to some of his podcasts. I mean, he has so much knowledge to share. And when it comes to money and mastering the game, this book really is it.
Perfect. Do you have a motto?
Don't give up. There's a lot of things that happen in life. We all go through a lot of challenges. We all go through a lot of changes in our life. And, there's always a light at the end of the tunnel, even though it may not seem like it's there, but to not give up and stick to your guns.
Love it. Sara, excellent job. Appreciate all of those answers. And I think Proust would approve as well. Hey, how can our listeners find out more about you, about Legacy Equities LLC, and how you can help them in their multi-unit commercial investing? Thanks
for asking. So viewers can find me on my website at www.passiveinvestmentpartners.com.
Sara Jung, Acquisitions Manager for Property Investment and Owner at Legacy Equities LLC. Thank you so much for joining us today. This was great.
Thank you so much, Rick.
And that'll do it for this episode of the Business Innovators Radio Podcast. I'm your host, Rick Brown. Until next time, keep innovating.
Thanks for listening to Business Innovators Radio. To hear all episodes featuring leading industry influencers and trendsetters, visit us online at businessinnovatorsradio.com today.